Good afternoon, everyone. It's my pleasure to welcome you to today's Fireside Chat, which is sponsored by the NYU Stern Center for Global Economy and Business. We're honored to have as our guest Dr. Mary C. Daly, President of the Federal Reserve Bank of San Francisco and its Chief Executive Officer. Before I introduce President Daly, let me invite you to participate in today's chat using our audience participation software. If you pull out your smartphones and go to www.slido.com and enter the number 1818 in the join box, you can submit questions and vote on others' questions. Your votes are critical because they will help us identify the topics of greatest interest to the audience. When submitting a question, please be sure to provide your full name. We do not accept anonymous questions. The program today will end promptly at 6:15. And now to our eminent guest. Mary Daly became president of the San Francisco Fed about 13 months ago. As the leader of the 12th District Reserve Bank, she serves on the Federal Open Market Committee, which determines U.S. monetary policy. Prior to her current role, President Daly enjoyed a long and distinguished career at the San Francisco Fed. She joined the Reserve Bank as an economist in 1996, rising through the ranks eventually to become Executive Vice President and Director of Research. I should add that the San Francisco Federal Reserve Bank is renowned for providing broad leadership to the U.S. Central Bank as a whole, including its recent presidents, John Williams, now head of the New York Fed and Vice Chair of the FOMC, and Janet Yellen, former Chair of the Board of Governors. President Daly's research focuses on the labor market and on the impact of monetary and fiscal policy. Other researchers frequently cite her work on economic inequality, wage and unemployment developments, and disability and retirement policy. President Daly has served on the advisory boards of the Congressional Budget Office and the Social Security Administration. She has become a strong voice for increasing diversity in the leadership of the Federal Reserve by strengthening the pipeline of women and minorities entering the economics profession. She received her PhD in economics from Syracuse University. Please join me in warmly welcoming President Daly to Stern. So just a reminder, we're going to go right into the chat, and it's my job to be able to read questions from Slido. So I'm going to try and make sure that this is up to date. But we'll start with the first question. Let's see if this is this updated. I'll give it one more chance. Somehow I ended up at the top. When the next recession hits, which unconventional monetary policies do you expect the Fed to employ?
So that's a really important question, and as so many of you probably know, the Fed is doing a framework review, and this was the idea of Chair Powell right when he took over as chair. He said, let's look at the framework and let's be prepared for the next downturn in a world where we're more likely to hit the zero lower bound. And so we've been actively thinking about those types of things. And I don't want to front run our decision because we're not going to make decisions about that until the middle of next year. But let me tell you about, from my vantage point, what I'm thinking and how I stack rank the tools that we have. So if you think of the tool, and we've made this very clear, that the number one tool we have is control over the Fed funds rate. And that's not going to be different. That's our number one tool. And it's the one that controlling a targeted interest rate is the thing that is our most powerful tool. We have the most history with it. We have the most experience. We know how it transmits. And so that's the number one tool. The second one, from my vantage point, that has been tried and true and we have regular practice at, is the tool of forward guidance. So think of forward guidance not just as the forward guidance we give when we use thresholds after the financial crisis. We're going to keep interest rates like they are until unemployment reaches this threshold, but also think of it as the summary of economic projections that we put out 4 times a year, and you see the median path for a variety of variables, and that is very much a type of forward guidance. Or even in the press conference when Chair Powell talks about what we're likely to do or what we're going to be looking for, that's another type of forward guidance. And then, of course, there's balance sheet policy, which we've tried and been successful at, and other central banks across the world have tried that. And then down the list, you get to other more less tried and true, but not outside of the realm of debate, and that is everything from negative interest rates to different types of changing how you purchase in the balance sheet. I would put those down the list because there's a lot of other things that could make those even less effective than they have been elsewhere in the United States. But I think we have three really great tools in the funds rate, forward guidance, and balance sheet policy.
Okay. Actually, the second question relates to what you were just talking about. Do you think that negative interest rates are a serious problem for the United States? How can the Fed introduce and use negative interest rates?
So negative interest rates are getting a lot of attention lately, but let me rewind you back to the financial crisis when we were in the aftermath. We talked about, and in the Fed, I wasn't on the policymaking committee then, but the system as a whole talked about whether negative interest rates would be an appropriate response. And Chairman Bernanke at the time, among with the other members of the committee, decided it wasn't an appropriate response for us in the United States. And there were other tools that we better served. And so some of the reasoning behind that is that the United States has a very different financial system than other parts of the world who are using those or which are using those tools. So one thing that's important is that negative interest rates affect depository institutions quite a lot. And community banks are an important part of the fabric of our financial system. Even though we often think of larger banks as doing most of the funding, community banks serve important parts of our economy, important parts of our communities, and we wouldn't want to disproportionately injure one of those community banks over other types of financial institutions. So that makes us very different than say, the European Union or Japan. The second thing I'll offer is that while negative interest rates are being utilized, we're still in very early days about whether they're effective or not. And there's a lot of research that's saying that it finds positive effects. I mean, you're in a university, you know that when you're in early days, the research is very unclear. There are studies that find good effects, studies that find more muted effects, studies that don't find any effect, and we are in the process of collecting all of that information. So from my vantage point, those are not on the table right now, but it's important for us to know all the tools and their potential effectiveness should we get into a very serious downturn where the other instruments that we have at our disposal have run out of their juice. But we are really far away from that, in my judgment.
Okay. This may be risky to ask a labor market economist, but aside from the unemployment rate, what barometers of labor market tightness do you monitor?
Well, I promise you one thing. I won't go till 6:15 telling you those other tools. So, one of the things that I think the main thing I want you to walk away with today on the labor market is that prior to the Great Recession, it was a very common thing in macroeconomics, and this would be true of policymakers, academics, and forecasters, to think the unemployment rate was a sufficient statistic, that we could get most of what we needed to know about the labor market out of just the unemployment rate as a measure of slack. And that became famously untrue during the Great Recession, probably always a little less than true, but importantly, Janet Yellen at that point in time, she was the vice chair, said, we need a labor market dashboard. And she even went out and said, we need a dashboard of indicators. And her favorites at the time were the quit rate and the job vacancy rate. So we have expanded that list quite a bit, and there are so many new series available, both macro aggregate series, but also micro series. The best way I know how to think about a labor market is to look at all of those indicators. And so my colleague, Bart Hobein, and I did this exercise where we just said, let's take all the indicators we have, no matter what the frequency is, and let's find out if they're leading, concurrent, or lagging indicators, and let's make a heat map. And the good news is right now, if you look at any of those indicators, they're all in green status, meaning that they're all suggesting or confirming that the labor market is very strong right now. And that is a very good aspect of this current expansion.
Great. So let's follow up on that. One of the questions that comes up a little bit later is, would it be a good idea to run the economy in an overheated form as a device to try and address inequality?
So let me define what I mean by overheated. So, because people have different definitions of overheating. So right now, if you look at the estimates that many economists, the policymakers, the FOMC policymakers have for the natural rate of unemployment, what the full employment level is when we're in full employment, it's higher than the current rate of unemployment. So you could think, well, if you've got that kind of a gap, that's overheating. But another, and I think better indicator of overheating is, do we see it in inflation? And when you look at inflation, we haven't sustainably hit our 2% target during the entire period of expansion, over this entire period since the Great Recession. So when I look at that, I want to go to the communities, and this is what we did in Fed Listens, and say, are there other costs about running the economy hot, if you will, an unemployment rate below what people estimate as the long-run natural rate, that we're missing? And so we went out and asked. And the Fed Listens events we held throughout the system told us no, that what these hot economies are doing is bringing in people who have historically been marginalized. They've been last to come into the labor market. They've been, when they do come in, they're in jobs where they don't have a lot of upward mobility. And what we're hearing now is many, many firms and many, many people who serve these less advantaged groups saying that, wow, we're getting people in we never thought we could. We're relaxing our hiring standards because maybe they were too rigid. And when we get these people in, they do a good job. So I see this as the balancing act between unemployment and inflation, the unemployment rate and inflation. And right now, with the unemployment, with the inflation running below our target, I would like to find full employment experientially, by looking at it in wage and price inflation, rather than just thinking we know what it is and then stopping short of achieving it.
Okay. Well, then broadening that question, what do you think are the most important policy tools that we could use to address inequality, not just monetary policy?
Sure. So monetary policy is an important pillar in this. And the important part of our role is to ensure that the economy is growing at a sustainable, healthy pace, achieving our dual mandate goals of price stability and full employment, which we just talked about. But we have a single tool, really, and two goals. And it's a blunt instrument. So we can't solve everything. And I don't like to, and I don't make a practice of telling other policymakers in a different space what they should do, but I will comment on my years of being a labor economist and thinking hard about inequality, what tools seem to work, what are the essential ingredients. So in every part of the research I've done, I uncover the same thing, and this is true in the literature. Education is important. It's actually critical. If you have too little education, then you actually can't take the jobs that are coming and becoming available. So if you get displaced and you have a high school degree, unless you get further education, you're likely to have resigned to a life of lower income after that. And younger people coming in, getting the right education allows them to take the jobs that are available. And then people immediately raise their hands in many circumstances and say, but a four-year degree isn't right for everyone. And my answer to that is, no low-income community or person has ever told me that. The only people who have ever told me that are people who have four-year degrees. And then they tell me that it's not right for everyone. And so it may not be right for everyone. In a perfect world, then we would definitely want to have a continuum of educational options, but we don't have said perfect world right now. And so I'd like us to work on parallel tracks. Let's educate the population we have and make sure we're closing these pretty substantial gaps in educational attainment by race, ethnicity, less by gender these days, but certainly by socioeconomic status. That is just not, when I was coming out of school, I gave a presentation in Johns Hopkins, and there were a lot of epidemiologists in there, and I learned something that I hadn't heard this phrase in economics. It was called face validity. Does it have face validity? And I said, what does that mean? She said, does it make sense to you? And when you see the educational attainment differences by race and ethnicity and SES, there's just no way that that's the distribution of talent in the United States. And so that seems a starting point to me for getting a better inequality, for reducing inequality, and importantly, for increasing the potential growth rate of our country. Because education is a key to having people work, but also be more productive.
This is about a specific indicator. How do you view the usefulness of the yield curve shape, an inverted yield curve, as a predictor of the business cycle, and how does the FOMC view it?
So let me speak for myself. It's I don't want to speak for other FOMC members, but let me talk about this from work that's been done in San Francisco. So at the San Francisco Federal Reserve, we have many economists who work on the yield curve specifically. And John Williams and Glenn Rudebush did a paper about how well the yield curve predicts downturns, predicts recessions. Now, the important thing about the yield curve is it's almost perfectly correlated. The inversion of the yield curve is almost perfectly correlated with a recession to follow in the 18 months after it inverts. But it's a correlation. And when you look into the theory, there are very few, if any, papers who can do a nice job of linking causality to that. So it's the correlation. So then when there's a correlation, as you know, you always want to dig into, well, why could they be correlated if they weren't causal? What could be going on? And the history tells us, and I'm very influenced by this, that a lot of times what was happening is the Fed was getting, it was behind the curve in terms of moving the policy rate up, and then it acted abruptly and raised quickly, and markets couldn't transmit that increase in the short end into the long end, and the yield curve inverted. This time, a different thing is happening. And it doesn't mean that this time is different, because that's a dangerous game to play, but this time a different thing is happening. Here's a couple of things to note. One, the inversions we've experienced have been shorter lived and not as large in magnitude. And the second, and this is a really, I think, compelling part of it, the difference isn't, in previous inversions, it was the short end went up quickly and got ahead of the long end. Right now, it's the opposite. The short end's coming down, but the long end's coming down faster. So it's the inversions are caused by the long end. And a lot of that is flight to quality. The size of our balance sheet was one of the things that people were talking about, pushing down the long end, but we've reduced that. So there are reasons to think that this time might be different, but I think it's always, I'm a good empirical economist, and so even though it's a correlation, we keep our eye on it, but I don't look at small perturbations. And someone asked me a couple weeks ago, are you relieved that the yield curve is in positive territory again? I said, I'm no more relieved than I was nervous that it had a small perturbation on the inversion. So it's really about the magnitude of the inversion and the persistence of the inversion. And then, of course, study for all of you is, why do they invert in the first place?
I think the next question is really about our forecasting ability.
I don't like to talk about that.
I was afraid. Well, let me pose it in a more difficult way. As far as I can tell, I'm not aware that the Federal Reserve has ever forecast a recession in anticipating policy. In fact, there are cases where they've discovered that the U.S. economy was in recession after that started. Is it really that difficult to make forecasts? What's the problem?
Sure, it is. It is really difficult to make forecasts, and it's not just the Federal Reserve or any central bank. It's actually a large group of people who spend their entire careers trying to forecast this. And you know, what I've seen in my career at the Federal Reserve is that what we're actually good at forecasting is ahead, what are going to be the trends in GDP growth, what are going to be the trends in inflation, what are going to be the things, when we get enough data, we can get pretty accurate forecasts 6 months ahead. When you start projecting 1 year ahead, and recessions are particularly hard because most of the recessions that we find ourselves in are about shocks. And shocks are by definition not predicted. We were going along steadily and some shock happens in the economy, a demand shock or a supply shock, and situations emerge where we find ourselves in a slowdown that then we're catching up to offset. So right now, if you think about where we are today, the last 3 interest rate cuts that we made are to be supportive so that we don't find ourselves with a slowdown that translates into something else. It's about getting the economy in a good place through the accommodative monetary policy actions we've taken so that we can continue to push against the considerable headwinds blowing again towards the U.S. economy. You know, we have slower global growth and geopolitical risk. Brexit comes up. If you just Google things that are risky, trade uncertainty, Brexit, and then slower global growth, all are pushing against us. But that's why instead of predicting that we'll have a recession, we actually think, well, there's policy accommodation we could take to ensure the economy remains in a good place.
Okay. The Summary of Economic Projections since 2012 has seen a fairly steady decline in the median projection of the longer-term interest rate. So why is that occurring? Why are we seeing a decline in the longer run rate that's consistent with the inflation target? Mm-hmm. And what are the implications of that?
So this is one of the most important topics of our day in macroeconomics, and it's something happening globally, not just in the United States. So the star variables, R star and U star, the natural rate of unemployment and the natural rate of interest in this case, they move primarily for structural reasons. I mean, you can have small fluctuations around the trend value, but they move for structural reasons. And R star is importantly moving because of population aging and slower productivity growth. So we have an aging population globally, and that's putting downward pressure on interest rates, and then we have slower productivity growth globally, putting downward pressure on interest rates on R star. So there's basically a global supply of savings that is in balance of the global demand for investment. And this is when as people age or they live longer and they retire, they want to keep their savings. They don't want to spend as much because they have to support their livelihood throughout their lives. And so this is going to put downward pressure on R star. And slower productivity growth, of course, means there's less demand for investment to fuel new ideas and new activities. And so that's less demand, greater supply, lower R star. Now the implications for this are very important. The implications for monetary policy are that we are going to have less policy space now than we've had historically. So if you look back and you look at how much the Fed has moved policy when we get a downturn, it's usually in the 4 percentage point range, and 3 to 5 really. And now we're going to have if the neutral rate is 0.5, which is what we estimate it to be currently, and inflation is 2, that's a nominal rate of 2.5, which means we can adjust the funds rate to 0 just with 2.5 percentage points of policy space. So that's critically different than the 3 to 5 we used to have and the 4 that we used. So this has profound impact on all central banks across the globe. And importantly, we study this a lot about how important it is not to get to the zero lower bound, because once you're there, it's hard. So you want to stay away from the zero lower bound as much as you possibly can.
So let me just do a follow-up on that. Obviously, some economists have suggested that one way to address this would be to raise the inflation target.
Yes.
How do you view that?
So we've said in our framework review, when we announced it, Jay came out and said, or Chair Powell, I should say, but he came out and said that we're not changing our inflation target. 2 is what we're going to hold to. It's a tried and true number, and we have a lot of success with having it. It gives us a cushion against deflation, but isn't so high that people feel like their dollar's losing value. So we're not changing that. The arguments for changing it are to try to get us up a little higher so that we have more nominal policy space. The issue I would push us to right now isn't about should we raise the target as much, because we said we weren't going to, but even then, not so much should we raise the target, how important it is to achieve 2. Right now, we've gone all this time without sustainably achieving 2, and we need to sustainably achieve 2 if we're going to go into the next downturn. Because this is a really way that helped me think about it. If we go into the next downturn with a 1.8 inflation rate, and that's what's translated into nominal interest rates, that's a 1 rate cut. Just about 1 rate cut less policy space than we have. So we need an inflation rate that gives us nominal rates that are high enough and gives us more policy space. So misses on inflation translate directly into misses or less policy space.
Okay. This is a question that was apparently posed before the Wednesday FOMC meeting.
Okay.
So I just read that the Fed will reduce rates a 3rd time because the market expects it to do so.
Oh.
Does the Fed set policy or just follow the market?
Yes. So I think that it's hard to observe who's moving whom when you're just looking at the newspaper, but the markets are looking out into, well, let me start by saying the Fed does not follow the market. So how does it happen then that they're highly correlated? Well, the first way it happens is that we're all looking out at the same data and assessing what is the most likely need for policy accommodation given the situation we're facing. So many people who work in the markets as economists are people who actually do similar things that the Fed does. We look at the data, we look at the information, they're good monetary policy economists, and they're thinking about what is the appropriate level of accommodation, so I'm going to predict that. That's one reason that they would be correlated. The second reason is that we speak a lot. And when the chair talks, people listen, and they factor his views, in this case, into their projections and into what they think is going to happen. And then, of course, the third factor in markets is they are actually trying to get there and bet on things before they actually happen. So part of the market is signal, and part of the market is noise. And if you're thinking about it as a policymaker, this is how I think about it, financial markets are important to the transmission of monetary policy and also into the level of monetary accommodation. So I watch them as a signal of, are they tight, are they loose, are they supportive, are they constraining, but I don't take them on and say, well, okay, we have to do it because the market said it. We've actually been very, I think, improved at communicating, and that improved communication makes this a little bit easier when we make our announcements, because people know what we're trying to accomplish, and then they've already baked it into some of their decisions, and that's another type of forward guidance, if you will.
So, broader question, how do you think about the balance between monetary policy and the financial stability goals of the Fed?
So the financial stability is not part of our mandate. So this is really important to separate. We have a dual mandate that Congress gave us, full employment and price stability. So those are the things we have to do. And then financial stability is one of the things that we're definitely thoughtful about. We have a supervision and regulation function as well. And we also know, and you saw the results of it, that financial instability can create quite a lot of havoc in our national economy and in the world economy. So we definitely keep it in mind, and we importantly study it. It's not just keeping it in mind, actually really working to study it. So we do something called the quantitative surveillance report, and then it's been recently, we're publishing this as the financial stability report. And we're going to be publishing one in just another week or a week and a half. And that is, if you open it up, and I encourage you to take a look if you've never looked at one, we've looked at talk about a dashboard. It's a dashboard of indicators in all markets, households, businesses, banks, non-financial leverage, financial companies, and said, are there any signs? Are there what's green, what's yellow, what's orange, what's red? Is there anything in there that we should be thinking about that we definitely want to understand? And when we look at these things regularly, and Chair Powell mentioned this just a couple in his press conference, if my memory serves, we're looking at that, there's nothing flashing red at us right now. And that's important. But what is also important, and we're keeping an eye on, I'm keeping an eye on as well as others, is this non-financial corporation leverage, which is higher than it has been historically. So you don't stop there and say, well, what do we do? We should stop stimulating the economy. Instead, you say, well, are the banks well capitalized? Do we feel, is that a financial stability risk, or is it simply an amplification of a downturn risk? And right now, the way I've assessed it is it's an amplification of the downturn risk, and it's important that we continue to talk to non-financial corporations and people take in that, a downturn that if you're highly leveraged in is worse for you than a downturn where you're more prepared. But I talk to CEOs all the time, and I'm finding a lot of my CEO contacts are saying they're starting to prepare for some rougher times. They see uncertainty, so they're getting their cash positions in a better place. And I think those are good signs.
Okay. Well, actually, it's related to the next question. You mentioned it earlier that the U.S. economy faces headwinds. You mentioned trade uncertainty. You mentioned weakness abroad. Mm-hmm. Why do you think that the global economy is as weak as it is, and what can the U.S. do about that?
So the global economy is weak for a whole host of reasons. So in Europe, they've had, there's geopolitical issues that are going on with Brexit, but they also had something in Germany, which was just this emission standard release. And that proved to be one of those shocks that was much harder on their economy than they had anticipated. So Germany's a big component of the EU. And so when they are struggling, then it filters into all the other countries as well. And then some of those countries are still actually struggling to regain their footing after the financial crisis. So they were already a little bit in a worse position than the U.S. because they never fully had come out of the financial crisis in the same way that we had in the U.S. So these shocks have pushed them down, and so they're slow. In China, it's a different set of reasons. In China, at least my assessment of them, in China, they're moving from a developing nation, which grows at double-digit rates, to a developed nation, which we know if you look at any of the maturity curves of growth, you level off and you get to a more mature level of growth or rate of growth. And then they were worried about financial stability in their own country, so they started taking out some policies against that, basically. And those things restrained them perhaps more than they had anticipated. And it's also at the same time that this trade uncertainty has really mattered. You know, I traveled to Singapore earlier this year, and then I traveled to New Zealand just recently. And when you go to that part of the world, what you see is people they're very concerned that they don't know what the new supply chain relationships are going to be. And so that kind of uncertainty, it acts like a demand shock, if you would. It acts like a shock to the demand for goods. And you see this in business investment. And you see this in manufacturing in the U.S. These demand shocks weigh down on us. And so what can the U.S. do? Well, we can't change the fact that the foreign economies are growing more slowly, but we can, as a monetary policymaker, what I'm responsible for is we can take out some accommodation to ensure that the U.S. economy continues to sustain its expansion, achieve its dual mandate goals, even in the face of these headwinds.
Okay. So this is much more associated with this audience. What opportunities exist for students of business and economics at the Federal Reserve banks?
Many.
And how can we make those opportunities more inclusive?
Sure, that's a great question. So the first thing to say is that many opportunities exist. And we just had, last week, I had Berkeley economics students of color, an undergraduate economics club, come in. It was amazing. And what they learned, they stayed the day, and I had them up from my office for a bit, but what they learned when they were there is that we have jobs throughout the organization using the skills of finance and economics, not just people who get a PhD in economics. So in the supervision and regulation function, in the cash product office function, there are people up and down our organization who are working in these fields. So, and that's true of the whole system. San Francisco is not unique in that. Anywhere in the system, we have 12 reserve banks and a board of governors. We are the single largest hirer of economists in the nation as a system, and we're an important voice. And so now to think about inclusion. How do we get to a more diverse and inclusive environment? Well, if you're the single biggest hirer, you can do a lot. So here's what we're trying to do. Every reserve bank is committed to sourcing individuals from universities that have a disproportionate share of minorities in their work, and going there early before individuals in those universities have decided that, boy, economics or finance isn't for me. Maybe economics and finance could be for you. Maybe you'll see yourself in these people. At the Federal Reserve Bank of San Francisco, you know, we've been working on this for a long time, and here's what we have come to. We can't wait actually until people get into college. We have to go all the way back to high school. We have to start getting people interested very early on. And if I can just take 15 seconds and say we just launched a new project, and it is really trying to do this. It's called My Economy. And in the My Economy project, the idea is super simple, that if you tell people you're going to teach them about supply and demand, then of course that doesn't feel very inclusive. But if you tell people economics and finance are issues-based, and then you teach them the tools after they become interested in the issues, then they may be more engaged, especially in communities of color or lower income environments. And so we went out with My Economy, and this project is simple. You take a picture on your phone of what economy means to you, and you write a caption. And I did a pilot. I did one for myself, and I took a picture of something I walk by every day in my neighborhood. It's a high-rise, and in front of it is a tent encampment. And my caption was, why do some people live in high-rises while others live in tents? And we're trying it out at high schools, and you can see the delight that's on people's faces when I give them those cards. And so that's what we're doing, and I know that it will take time, but we have to have a multi-pronged approach. Go all the way back to those schools, when I come and visit students like you, I say apply for our internships, apply for our research assistantships. We have Chitra right here in front. She's proudly wearing the Fed Ambassador of San Francisco t-shirt, sweatshirt because she came for a 2-year program. And we place people all over the country in graduate school if they come for us as a research assistant. And then, of course, we have a lot of interns. They come back and they work for us in all aspects of the organization. And so the opportunities are there, but we are trying to reach out and encourage you, and then we need you to kind of think about the Federal Reserve maybe differently than you might have if you simply look at our history. I want you to look at our future.
Next question is about central bank independence and the president's attitude towards the Federal Reserve. How should the Fed react to the president's attempt to influence Fed policy?
So the Federal Reserve is an independent central bank, and we have so much history thinking at it nationally, but across the globe, that an independent central bank is now a proven concept, that works best. That's the way to do central banking. And so the way that we think about it is that independence means that when you walk in the room of the FOMC, so it's a beautiful room and it has these big doors. And when you walk in the door, you open these big doors and you cross this threshold. And crossing the threshold has a certain reverence to it. You cross the threshold and you walk in and you remember that, and you know deeply that what you're doing is you're trying to achieve the dual mandate goals and serve the American people. I don't know if you've read Chair Powell's press conference statements, but every time he starts with, our job is to serve the American people. And that's actually how we work. And so politics and discussions of politics, it literally never enters into the discussion. We never talk about it because that's not the job we've been given. The job we've been given is to achieve the dual mandate goals and promote a sustainable and healthy economy. And to a person, that's what we do.
So the next question is sort of about, on one hand, it's about the changeover in leadership at the ECB, but it's a broader question. First of all, what do you expect from the European Central Bank in terms of policy, and how does it affect policy in the United States?
So how can I put this? One of the reasons I absolutely love working for the Federal Reserve is that the person who's heading it is less important. We don't run an iconic leadership model, really. I mean, we've had people who might have been iconic leaders, but it's not an iconic leadership model. It's a model of everybody gets around the table and does their best to debate and think about these things. And the ECB is the same way. So when you ask me, what do I expect from policy, it doesn't relate to leadership changes. It actually relates to what are they facing and what are they responding to? Because all central banks who are really focusing on this are focusing on how do we best achieve our goals, whatever those goals are mandated to be. So my expectation is that they will continue to offset the downturn, the slowdown that they're seeing, and they have inflation below target and they have inflation expectations drifting down. And so they're going to work to fight that, whoever's in leadership. Now, how does it affect the U.S.? Well, we already talked about slower global growth affects the U.S. But another thing that's coming out in the research literature, and some colleagues of mine in San Francisco are doing some of this work, is that when the European Central Bank and other central banks across the globe lower their long-term interest or their interest rates, their short-term interest rates, and long-term interest rates even get more downward pressure, then we talked about that R star, and I talked about it being in the long run maybe 0.5. Well, this is putting downward pressure, maybe temporarily, but putting additional downward pressure on the natural rate of interest. And so the R star that's temporarily with us might even be lower than this 0.5. And that would mean potentially that our policy is more constrictive than we anticipate. So we have to study this, we have to think about this. When I was supportive of the 3 interest rate cuts we took, and there were a variety of factors. Inflation's below our target. the unemployment rate. We don't really know what full employment is, and let's learn about it experientially. And our star right now might be lower than it is in the long run because of these temporary factors. And then of course we have headwinds coming from global growth. So that's how it affects us, is their actions absolutely do. We're a more integrated economy now than we were just a decade ago even, and that matters. So we have to think about this when we make policy.
So the next question is really about the money markets, and it's posed the following way. What was the role of the Fed in the repo market developments last month, or actually in September? More broadly, how is the Fed managing to attain its operational targets, right?
Sure. So in a nutshell, without going into a deep discussion about repo and going to 615 with one question. So in a nutshell, we, in January, announced we were going to run an ample reserves regime to execute monetary policy. And so this is different than the scarce reserves regime we ran before the financial crisis, where we're in there trading every day so that we can hold the funds rate at its target. So we're going to run an ample reserves regime with administered rates, and ample is going to be defined by not having to do regular open market operations. So that's the program we want to run for the execution of monetary policy. At the same time, we're normalizing our balance sheet, pulling off the QE and coming down to a level that is then ample but not stimulative. And that's a learning process. And we had been out doing market intelligence, asking the New York Fed was in charge of this, the markets desk. They're doing market intelligence. They're asking institutions what's the lowest minimum level of reserves you're going to hold. And what we found in September is they were holding a lot more than they had said they were going to hold. So we ended up with fewer reserves than we need to run an ample reserves regime. And so for a day, the funds rate breached its target range. And that caused some consternation. But just so that we all understand the facts of this, in the pre-financial crisis era, temporary breaches of this day or two were not uncommon. This is something that happened. So it is not a crisis that they breached, but it is something to think about because it's a signal that maybe our reserves isn't as ample as we wanted it to be. So we had an intermeeting meeting, and we decided to build back up the level of reserves to a level that's at least as large as it was before this occurred. And we also are doing temporary our open market operations through January, and you can see that this has really settled the repo markets. The funds rate's been trading nicely within its range, and that decisive action on our part has helped quell any of those issues. And importantly, there was a real understanding, and I'm very happy about this, that this is just it's the plumbing of how we execute on monetary policy. And that plumbing, you have to get that right, but it's really just about making sure that you can execute on your goals, which we are now fully doing.
So you mentioned earlier that one way to interpret the trade policy uncertainty is as sort of a demand shock, that it affects the willingness to invest and spend. The question here is, has the Fed done enough to offset the uncertainty that's being created about trade?
So in my judgment, we have done a sufficient amount. And the really important thing that I'll emphasize is, this is not what I would call delta-delta. It's not delta data, delta policy. The policy rate's all about the level of accommodation, not, a new piece of negative data comes in, so we have to change the policy rate. It's about what's the right level of the policy rate to make sure that the economy has sufficient accommodation that it can continue to grow against these headwinds. And it's also important to remember that monetary policy acts with a lag. Between 1 and 2 years it takes for the monetary policy actions to fully transmit through the economy. So when I look at that, the lags in monetary policy, the effects we've already have, and the strength of the headwinds relative to the amount of accommodation we've taken out, I see an economy in a good place. And so think this is sufficient, but of course, we're vigilant. And if things unfold in a way that's different than we had projected, if the outlook substantially changed, or we get one of those shocks that we talked about that are hard to predict but easy to see once they've occurred, then of course we would be flexible, because ultimately we're back to, I know it sounds like I'm just saying this again and again, but it's really the tether that always you come back to. Our job is to sustain the economy to achieve our dual mandate goals. And if we see an outlook that looks substantially different than the one we projected with the accommodation we have, then we would make an adjustment appropriately.
So this next question goes back to what you were talking about a moment ago. The Fed has made an adjustment to increase the supply of reserves, or make sure that the reserve supply is at least as high as the early part of September. And in doing so, and part of the action has been to go out and buy assets and increase the size of the balance sheet again. So the question that surfaces is, why does the Fed, and Chair Powell has actually said this, why does the Fed argue that this is not quantitative easing?
So quantitative easing, to think about this, is that you're really building up your balance sheet so that you can change the yield curve. We talked about that, right? And importantly, we did Operation Twist, is what it was called. So we were buying at the long end, and we were trying to pull down interest rates at the long end. We're buying bills. So we're still in the short end. This is all open market operations, if you will. This is building up the reserves at the short end so that we can have ample reserves and be able to execute on our monetary policy. So it's decidedly different than quantitative easing. It is about doing what we said we would do, which is have an ample reserves regime where we can control the interest rate through these administered rates and have the funds rate trade in the range that we've set. So this is about that, and it's not about trying to change the shape of the yield curve, which is what quantitative easing was about.
Okay. How does monetary policy relate to the challenge of addressing climate change? Is there a role for policy, and if so, what?
So I think about it like this. So we're having a climate conference on Friday, a climate change conference, and so I'll talk to you about what I'm going to say there, and what is the value proposition? Why would a Federal Reserve, why would any central bank think about these things? And it is beyond monetary policy. So we have three core functions. Our first core function is the payment system. We're responsible for a safe and sound payment system. And the number one thing that people look to in times of severe weather events is cash, because your electronic payments, they don't work in many cases. And so we're responsible for that, and we just have to risk manage. We have to make sure that we have cash supplies available and that people can get to it when they need it. So that is one of the reasons this is strongly right in our radar. The second one is we're responsible for supervising and regulating banks. And banks, increasingly, especially if they're in areas where there's a lot of geographic risk, they're looking at their balance sheets and having to think about pricing that risk. What if there's a shock, a climate event, right in an area where they have most of their loans? Well, that's a shock to their balance sheets. Either they own assets, or because people can't pay on the loans that are due because they don't have their jobs any longer. And insurers, of course, are potentially out quite a few payouts, and are they well positioned to do that? So that's another reason we think about it. And then the third one is that climate risk warmer temperatures are things that economists and other researchers are saying are starting to curtail our GDP growth. Now, the jury's still out. In my mind, again, it's early days in studying this, but if this is true and we can replicate these studies and find this, then monetary policy is going to have to think about what is the potential growth rate of the economy. And the final thing I will say, because this sometimes gets lost but is actually really important, is the reserve banks, we're public service. We're community-facing organizations. And so we have to understand the communities we live in, and climate risk, and whether it's the shoreline is creeping up or you're now in California, we've had a terrible bout of very severe fires with evacuations, loss of property, people being out of electricity because we have to shut the electricity off so that we don't get fires erupting.
Has that affected the San Francisco Fed directly?
Not our Fed building, but many of the employees who work at the San Francisco Fed have either been evacuated or lost their electricity in this period of time. And so this is a real material challenge for us, and we have to be focused on it, not just for our employees, but for the entire community we serve. So these are all the reasons why there's an important and real priority for us. We think of it, I think of it, and my team thinks of it as, it's the prudent way to think about doing our jobs, is to think about the risks associated with the future, and preparing for the economy we have in the future is part of what we do.
So taking you back to the labor market.
I like this going back and forth.
We've seen unemployment fall to levels we haven't seen for 50 years, the unemployment rate, and yet inflation has gradually risen, but pretty slowly compared to historical patterns. So what does that tell us about the Phillips curve? Is it still a useful tool for policymakers?
Well, I think it is useful, but it's flatter in real time. So let me start with, it's very hard for me to overturn core principles. So the core principle is supply and demand are related, and if you, I'm hard pressed to give that up. So if the labor market gets tighter, you would think that wages would rise. But there's all sorts of wedges that get in and interrupt that. So in our simple textbook models, labor market slack goes down and wages rise, and it's nearly immediate. And then that translates into prices, because wages and compensation is 2/3 of employer costs, and so they raise prices, and that all works beautifully. But we don't live in a textbook world, and outside of the textbook, all these wedges interrupt. And one wedge that can interrupt is that workers don't have the type of bargaining power that they would allow them to say, well, we want a wage increase when it's hard to find laborers. Another wedge that we hear about a lot is that employers are getting from their employees that they're not as interested in simply monetary compensation in a world where it's hard to find housing. So they want a housing, like a group of houses that they can rent, or they want a housing subsidy. And all of that is a form of compensation, but doesn't get treated oftentimes in wage and salary growth. So those are some of the wedges. And then what's the wedge between wages and prices? Well, in wages, we live in local labor markets, but in prices, we live in a global economy. And if you're raising your prices in a global economy, then you might be out of business. And so that can cause a wedge, just globalization, because wages, again, are local and prices are global.
So actually related to that, there are two big forces that we always talk about affecting labor markets. Globalization is one, automation is another. Are labor markets adapting as well to automation as they did, say, 20 or 40 years ago? Are we entering a period where we have to worry about whether automation is going to unemploy a very large portion of the U.S. population? So the
first fact that's really, I think, important to keep in mind is that automation actually displaces more workers than globalization. And there are now many, many articles written about this, people looking into this. So it doesn't mean, but both are important. But automation is the way that most workers in the U.S., when they do get displaced from industries, are getting displaced. You're changing what used to be done manually into what can be done with machines. So this is a perennial issue, starts back in the Industrial Revolution when we're mechanizing things and people will get displaced. And the recipe that is needed, is required, is that you then skill the population up so that they can take the new jobs that are being developed. So I was having a CEO roundtable lunch with people who do AI and in all kinds of businesses. And what the gentleman who was using, his company was making driverless trucks for distribution. And he said, I employ as many people as I'm displacing, but they're just different people. And so the recipe for us, and I don't think we're where we need to be by any stretch, is we need to educate our population for the jobs that he's creating, because the jobs that he's replacing, they'll go. It's just a matter of time. And so instead of trying to keep those jobs, it's about taking individuals and saying, let's get you ready for the next jobs. And we're behind. We're woefully behind.
So we're losing the race between education and technology?
We are. But that's in our control. These are not out of our control. It's about taking the simple actions to say these are the jobs that are going to be created, and you need to get education to do them. And the thing that's likely to be true in the future, in fact, I think I'm going to be better at forecasting this than other things, is that people are going to need to be continuous learners to improve their educational attainment over their lives. And that doesn't mean they have to go back to four-year schools. It means acquiring new skills as the economy changes. This is an economy where it's unlikely that people are going to come in early in their career and not have to skill up as they age through their career. And getting our people, our country prepared for that, and seeing that's the way to raise up your mobility as you get older and more advanced in your career, I think that's the heavy lift. And you're seeing it in European countries. They're starting to talk about this, and I really like this to be part of the conversation in the U.S.
So we keep going back because I think this is like a corn hog cycle. The audience keeps responding to your questions with a lag, your answers with a lag. So this is about independence again, but it's about the perception of independence. So you made a fairly compelling argument about how FOMC members leave their partisan hats at the door when they enter the room for the meetings. Mm-hmm. But what about perception? Do you worry that the perception of Fed independence is affected when the central bank is under continuous attack from the president?
I don't, and here's the reason. That when people see that we take our policy actions, and those policy actions are not perfectly correlated with the desires of markets or a particular academic or a fiscal policy maker, they say, oh, okay, that isn't perfectly correlated, so it gives them a little shred of doubt that there is this influence, and then there's an opportunity for us to narrate how we actually think of it, and that's what we've been doing. I mean, I go to events like these and I tell you how we actually do it, and my colleagues go to events like these and they tell you all how we actually do it. And so I think the lack of perfect correlation between our actions, and we continue to reiterate that our actions are for the American people, those two things go together in a way that is supportive of our independence. I also think that people understand that an independent central bank has been a successful part of the U.S. economy for a long time, since 1913, really. And that time and time again, this is not the first time that we've faced these types of challenges. It's not. It's just a very public version of it.
Right. So Professor Pugel, I think, is in the audience somewhere. There he is, back there. Has a great question about, you mentioned some of the indicators you look at for assessing the labor market. You mentioned that you create an entire dashboard of all the indicators you're able to obtain. What about for inflation rate expectations, which matter a lot for policy setting? What are the indicators you look at? What does the FOMC think is really important?
So the ones I look at, and my colleagues look at, we all look at a variety of ones, but let me focus on the ones that I look at. So for inflation expectations, there is no single indicator that is going to tell you everything you need to know. And in fact, they can move around for a variety of reasons. So I look at survey expectations of consumers and businesses, and I look at market-based expectations, which are what people are trading on. You know, we used to have people putting their money where their ideas are, so the tips market, et cetera. There's a lot of financial versions of inflation expectations you can keep track of. And so what we're seeing is, and you know, in labor economics, because we can't know anything with a capital T truth, I think that's true in research generally, but it's really true in labor economics, that you essentially end up with a preponderance of evidence. You're looking for a range of indicators that all point in the same direction, or they're just flat. And what we're seeing now is that no matter what metric you use to evaluate inflation expectations, there's a little drift down. So I am not convinced that our inflation anchor has fallen yet. I still think we're at 2%, but we've got downward pressure on inflation expectations because we've consistently missed our 2% target. And I've said before, and I continue to believe it, if you consistently fail to deliver on what you say you're going to deliver, eventually the anchor does drift. And they've seen this happening in Europe. This is one of the things that's problematic, and we know how important well-anchored inflation expectations are, because they actually help us keep inflation where it needs to be. And at some point, if we don't deliver on this 2%, I'm worried they will fall. And I think we're starting to see some evidence that they're getting a little bit more fragile than I would care to see.
So that brings me to the next question, which is, you've mentioned it already at least twice, that over the last 7 or 8 years, inflation's been below what the Fed has forecast. Why do you think the Fed has overpredicted inflation?
Well, inflation has behaved differently than we have historically seen it behave. And it's really hard. This is the hardest part of doing any kind of work on the economy. When structural factors and cyclical factors are perfectly timed together, it's hard to decide which is the cyclical and which is the structural. So what's happened in inflation, from my vantage point, how I see it, is that while we were waiting for the cyclical component of inflation to come back up, and it was probably doing a little bit of that when we look at the data, there's all these structural factors that are pushing inflation down. So we are going to spend the next decade at least fighting inflation from below our target, because the structural factors are pushing it down, not pushing it up. And as a consequence, we have to be even more thoughtful about getting the cyclical component of inflation up beyond what we have had to do in the past, because the structural factors are all pushing it down. In the past, let me just give you an example of the 70s. In the 70s, which most of you weren't born in, but in the 70s, there was really this structural factors were pushing inflation up. Healthcare and other things were moving inflation up, and so the cyclical component was trying to discipline inflation down to 2%. Now it's the opposite. These other factors, these factors that are not that cyclical, are pulling inflation down, and we have to move the cyclical component up just to achieve 2%. And that's a different world than we've been in. So the bottom line is, why have we over forecast? Because we were learning that a lot of the structural factors are on the downward side. I think we're learning, as all economies in the world are learning, that the new role of central banks is to fight inflation from below the target, not above the target.
So linked to that, you've argued for central bank independence. The traditional argument for central bank independence was it provided sort of a device to overcome time consistency problems, to be able to make a credible commitment about an inflation target over a period of time,
right,
or about price stability.
Right.
Is it as important to have that kind of commitment that's credible when you're fighting inflation problems from below your target as it was from above?
I think it is. I think it's really important. In fact, I would say right now it is critical. So I started part of our discussions by talking about how limited our policy space is and how missing on our inflation target eats away at the policy space even more. So we need to credibly have inflation averaging 2%. And I think a lot about whether that would require, and I'm not speaking for the FOMC here or revealing any of our framework discussions, but what I've been thinking a lot about is, do we need average inflation targeting over the business cycle in order to ensure that people, agents, consumers and households and businesses, that they know that we're going to achieve 2%. So that means in a downturn, we'd run below 2% because there's a lot of slack, it pushes inflation down. But in the upswing, we would be above 2%. So that on average over the cycle, we could average 2%. So I've been thinking a lot about that because I feel so strongly that a credible commitment over the period is essential to having well-anchored inflation expectations. And well-anchored inflation expectations, those are really the things that help us keep this volatility in our economy to a minimum, which is important.
So the top question on the list is specifically about China, the potential for implementing a sovereign cryptocurrency. But let me broaden that out. There have been proposals that central banks create digital currencies. Mm-hmm. How do you view that?
So the Federal Reserve has come out and said that we're not on our list thinking about a digital currency. And instead, we're focusing right now on this, I don't know how many of you know about it, this new project we're doing called FedNow. And that is a real-time gross settlements rail system that allows individuals to be able to settle things in real time. And this has a lot of advantages to the economy and to economic agents being able to transact in this way. The thing about digital currency, and this is something that, again, I don't think many people really know, is that we house the cash product office in San Francisco and the Federal Reserve Bank of San Francisco, and that means that we're responsible for the entire system to managing the cash operations. And what we find, but it's really hard to convince people of, is that cash is in high demand. There is not a shrinking demand for cash. People still use it as as a form of payment. When things get tough, like in times of crisis, people resort to cash. And people keep cash for all kinds of things, small payments, privacy, a variety of different things. So when you live in a big city, or you live in a tech heaven like San Francisco, you think that people don't use cash, but they do. And I'll give you a little story about myself. I needed to get something done on my shoes, and the guy had just closed, and I didn't have any cash because I don't carry it. I mean, they're going to kill me in San Francisco, but I don't carry it. And I had to go borrow cash from the person who cuts my hair so I could pay the shoe person. And then I had to write, when I did my Venmo to the hair person, I had to say, here's the extra $5 for my shoes. So cash is really important, and I'm starting to carry it.
So actually, in that connection, at least several economists proposed eliminating cash.
Yes, I know.
And Ken Rogoff is one arguing that it contributes to criminality. It actually prevents the Fed from setting really deeply negative interest rates. Would we be better off if we could eliminate cash in the United States?
Not in my judgment. And here's something that I think gets lost in the conversation. If you're thinking about eliminating cash, there's often this itemization of all the things that are bad about cash. But there's not the column of all the things that are good about cash. So we do a cash diary survey where we ask people, what a payments diary, what do you do? And people tell us all the reasons that cash is important to them. And so a fair evaluation would be to look at the cost and the benefits. And when I stack those things up from my vantage point, I come out as cash is still very important to many, many Americans. And eliminating it would be disproportionately hurting those who rely heavily on it, which happen to be more and more in the lower part of the low and moderate income part of our distribution, and in geographies where cash is still important. So again, I don't want us to have so much of a big city, and there's a danger in self-reflection. And if you self-reflect too much, introspection, you can end up leaving out large swaths of the population. So self-reflection would say cash isn't very important, but my own experience has contradicted that. And I think the experience of going out into the 12th district and across the country contradicts that as well.
Okay. We have, at least some parts of the yield curve, effectively negative real interest rates. If people believe the 2% inflation target, and that's credible, then we have some parts of the yield curve where real rates are sub-zero. Do you worry that that can lead to misallocation of resources?
A little bit. I mean, certainly that we know that there can be misallocation of resources, but it's a little bit like what we talked about with the full employment thing, the issue. So basically, people are worried that these misallocations are material. And so they can be there, but not be first order. And right now I have no evidence that they're first order. And if they're there, they're small. And I don't think they're resulting in distortions that are not worth the other benefits that we're seeing. So again, it's really just cost-benefit analysis. And it doesn't mean that there's no cost, but what it means is that the benefits completely outweigh those.
Okay. There are lots of questions left, but they're getting harder to look at because people aren't voting. So first, let me encourage you to vote.
Otherwise, just pick your favorites.
Well, I'm getting down to that level, or creating answers. Someone asked about universal basic income, suggesting that it's essentially a response to automation, as a way that it's been offered as a solution to the effects of job losses due to automation. Do you think that a universal basic income policy would affect the inflation outlook in a meaningful way?
Not really. I also think that I'm a student of history. I would encourage all of us to be students of history in this regard. So the universal basic income was something that was proposed under the Nixon administration and thought about, and the concerns that were raised by Democrats and Republicans alike back then So this is a Republican administration that proposed this, and what we got out of it at the end was the Supplemental Security Income Program, which is basically a negative income tax program or a universal basic income for people with specific classes. They were poor and they had a disability, or they were elderly and they were poor. And the reason for that is that there was real concern that that type of thing can result in a lot of people never being able to fully integrate into the labor market because the incentives weren't right, and also we would stop investing. And in European nations that tried this experiment, what they found is that they're rolling out of that now, and because they're worried about not being able to what they call activate a large fraction of their labor force. So the answers of universal basic income, I think we should think about all of these things, but what I would really encourage us all to do is to think about the whole social safety net at once and ask, do we have the social safety net in place for a modern economy when we built much of the social safety net long before this modern economy emerged? And I think that's a reasonable discussion to have in our society, and to ask not atomistically how can we fix the one we have, but rather generally, how can we rethink what we need in a world where we have all these other things? We're in a global economy. We have automation happening in a much more rapid rate. So that's how I think of it, is from all the years of research I did on these topics, it's really about trying to be more holistic. And from my vantage point, or my opinion, it's a really good time for us to step back and think holistically.
So we're coming back to R-star. The Fed doesn't control R-star. It takes it as an exogenous fact of life. But there are policies that could affect R-star. You could have fiscal spending or tax cuts. You could have infrastructure outlays.
Right.
You could change regulation in some ways that would affect R-star. Maybe you'd like to comment on the ways that you think might be useful, at least from the point of view of the Fed, having more monetary policy space. That is how we might try to alter R-star for that purpose.
So interesting. You might find this interesting, but I don't think of these policies from the lens of how can we alter R-star. I think of them from the lens of how can we ensure that our economy can reach its potential. And so I am a proponent, I've been public about this in other venues, of saying that we need to invest in our physical infrastructure, but more importantly, or equally importantly, our human infrastructure, our human capital. And so those are two assets that we can have, our people and our basic physical infrastructure that absolutely materially change the potential output of our country. And that's a good thing. The pie getting bigger at a faster rate is a good thing. That will actually fall back and increase R-star as well, but the reason for it is motivated from my vantage point for increasing our potential output, which we want to, this may sound overly optimistic or too Pollyanna-ish, but I really do believe we should try to deliver a future to our next generations that's better than the one we inherited. And so that should be our mantra.
Well, we're just about at that time, so I hope you will join me in thanking President Daly for this excellent chat.
Thank you.